Good people, what's up? What's up, good people? How you doing today? Hey, you guys know how we do it if you've been here. Continue to hit that like button. If you're just coming on, don't hit it twice, because if you hit it twice, then you're unliking, all right? Hey, if you're new to the page, go ahead and hit the like button, subscribe. We got 4 minutes to the FOMC meeting live. And as you could see, the Dow is down. S&P is still doing good, 34.75. S&P is good. NASDAQ. All right, let me make sure I got volume going. Yep. Hey, good morning. Good morning. Good morning. Hello, everyone. Hey, you guys know how we do this. Hey, good morning. Good morning. Hey, so in a few minutes, let's just go right into some of the things that I had for you, and we're going to go start. This time I'm going to stay live. I'm going to stay live from the FOMC, his announcement about the rate. And then we're going to stay live. As you can see, the Dow is tanking. All right. So, and then I'm going to go. That's right. And then we're going to stay on for a half hour between the release of the data. We're going to stay on for a half hour, and then we're going to actually just stream the whole FOMC meeting live. So you guys know how this goes. We watch the markets. We watch what he says. As he talks, the market goes up, the market goes down. I will tell you now, hey, much love. Hey, Simply Shah. Hey, good morning. Good morning. Aquita, Reed. Hey, Charles, good morning. Good morning. Good afternoon, rather. SoFi. It's funny you said that. I'm going to keep an eye on SoFi, Tesla, and Apple. Right? SoFi, Tesla, and Apple. I'm going to keep an eye on SoFi, Tesla, and Apple. If the Fed said something that causes it to go down, I may jump in. Now, I know I always say that only somebody extremely risky would trade during the FOMC meeting, but I am in a few plays that I want you guys to know that I'm in. All right, let's go right to it. Look at that. So these are Chinese ADRs. I got into them yesterday. One of the Alibaba 90 call I was in since Friday. As you can see, I got these set out long enough for them to recover. I'm going to babysit these and add more to the positions. They may go down, so you guys know about what I'm doing ahead of time. You'll be able to get it in at a better time. Also, too, for crypto, Riot and Mara. If you don't trust the platforms, if you don't trust crypto, here is a way to get in. Okay, so we got 1 minute. I just want to let you guys know I'm keeping an eye on SoFi, Tesla, and Apple. If he says something that causes them to go down, I may get in. Right? All right, so let's look at the indices really quick. Look at that. Dow, S&P, and the NASDAQ are all down. So let me bring it up high as we go right into the meeting.
Will they talk about additional policy firming still to be needed? If so, I think that's, first of all, at least a broad hint that there probably are more rate hikes to come. I want to see if they revise up the terminal rate.
I also want to say, make sure you check out, don't fall for any spam below. Make sure you check out the top 2 links, the top 3 links below today. I got a class that teaches you everything. We got Moo that's giving you deposit $100, they're going to give you $100. Make sure you do that today. All right, here we go.
Policeman with the Fed decision, Steve.
The Federal Reserve pausing, but raising the median forecast of the funds rate to 5.6%, indicating a very hawkish committee outlook and strong support for at least 2 more rate hikes this year. I think this comes under the definition of a hawkish pause, maybe a very hawkish pause. FOMC statement saying it's holding the target rate steady, allowing it to assess additional information, including the cumulative effects of tightening and lags of monetary policy. I want to go through in detail here the summary of economic projections and the funds rate. Only 2 members of the committee are forecasting the rate at the current rate of 5.13%. 4 support 1 more hike. 9, or half of the committee, is forecasting 2 more hikes. But there's more, because 2 are supporting 3 hikes, and 1 supports a full percentage point higher or 4 quarter-point hikes in the funds rate. The committee sees more inflation this year than it previously did, forecasting a 3.9% core rate versus 3.6 in the prior economic projections in March, and less unemployment, 4.1 versus 4.5. And moving on, they did see better economic growth this year, not tremendous, but 1% versus 0.4%. The statement said the economy continues to expand at a modest pace. Job gains have been robust. Unemployment has been low and inflation elevated. They continue to say tighter credit conditions are seen weighing on the economy, hiring, and inflation, but they don't act as if they will. Decision was unanimous. Guys, I just say, in terms of a hawkish pause, this is for sure that, with at least 2 more rate hikes forecast by the majority of the committee, and some want 3 and some want 4. And also, one other thing you want to look at is if you look at the real rate forecast, the one that was the nominal funds rate minus the core PCE they forecast, they're actually even tighter still. They had been forecasting 1.7. Now they're forecasting a real rate at year end of 2%. So that's even tighter than they had previously thought they'd be. Guys?
Wow, Steve, we don't even know where to begin, but stay there as we look through this. The market reaction obviously is initially sharply lower. Usually the market's a little slower to react to and saves this for later in the session. But right now we see the Dow tipping lower by about 200 points and the 10-year yield jumping to 384. Let's bring in Bob Pisani, Rick Santelli, along with the rest of our panel. Rick, what are your thoughts?
You know, my thoughts are, considering how Steve presented what the Federal Reserve is not only doing now, but what they intend to do. Of course, it makes the data-dependent part of me explode. But how could the markets not see interest rates rise and the Dow fall? What Steve said sounded hawkish times 10. But to me, if you listen to the Fed and you looked at the last CPI number, you're basically looking at old news, in my opinion. Let's just start with number 1, seasonal adjustments. Okay, one of the big issues that pushed CPI into hotter territory were used car prices. First of all, Manheim used car prices are seasonally adjusted. All of our jobs numbers, for the most part, are seasonally adjusted. And I continue to say seasonal adjustments aren't what they are cracked up to be, A. B, I think a lot of the used car prices are stale. Everything I'm seeing starting to come through looks a lot different. And
I literally just bought this option. You don't have to follow me. Anything you do is this is short term, 2 weeks.
Report. That's not all. Let's think about the trim mean, the 16% trim mean.
Again, this is the option that I just bought just now. Not a lot of money. I'm not going crazy, and I may add to my positions if it goes lower.
3%. So I think there are a lot of reasons to be nervous if you look at more stale data and you assume that these numbers are going to perpetuate themselves. But I think the reason equities were so strong yesterday is some of the traders have looked through the numbers and are trying to look towards the next several reports. And I think the future they see is different than the past.
All right, let's go to Bob Pisani for a quick update on where the stock market stands right now. It looked like it started to nosedive immediately.
Yes, but only about 25 points in the S&P. That is not a huge move. So remember last time we had a dovish hike, and this time we get a hawkish pause. I'm not sure this necessarily changes a lot. Certainly, you got half the committee supporting 2 more rate hikes. I think that's a lot more hawkish than equity traders anticipated. But I'm not sure it dramatically changes the situation. What we've seen here is the S&P right now is trading at nearly 19 times forward earnings. That is not only not a recessionary multiple, that is an expansionary multiple, and 25 or 30 points on the S&P. The problem right now, and maybe this is a good pause right now, is the S&P and the markets are really pushing the limits of the soft landing story. We've moved up 5% just this month because the jobs report.
Sorry, good people. I was trading.
and the belief is the Fed is near done. I'm not sure 1 or 2 more points or 50 more basis points really makes a difference. So here's the hope for people wanting the market to move forward at this point. The volumes have been terrible recently. A lot of people still don't believe this soft landing story. And all of those people who bought treasuries, 1-year treasuries 3 months ago at 4.5%, the S&P is up 13% since that happened in the middle of March. And the question is, regardless of whether we get a 25-point drop in the S&P right now, which we just got, whether or not those people are going to get any kind of FOMO and believe that the economy is going to remain relatively strong. There's your hope for the market to move up right now.
Incredible reactions here. Dow's down 334 points. Greg, do you think this is them putting the knife in the soft landing story?
Not really. I was just actually looking over the numbers here, and actually, if you take the numbers at face value, they almost sort of strengthen the soft landing story. They've got GDP growth up more this year, like I think around 1% versus 0.4%. Tiny little trims to it next year and the year after that. Unemployment rate lower over the forecast horizon. So actually, if I look at the unemployment and the GDP forecast, the Fed seems more comfortable with the soft landing story. The weird thing is, but they have that against a world of higher inflation. So in some sense, they're saying, we think we can still get the soft landing, but given that inflation is a higher problem at the start of this process, we need to get the short rate higher to make sure that happens. I got to say, there aren't a lot of precedents for pulling this one off. I mean, I hope so. The market clearly hopes so. This is a balancing act they got ahead of them.
Julie, how do you react?
I think that the rate increases, as was mentioned before, are more about messaging than they are about their real financial impact. I think what's actually more meaningful going forward is what happens with the Fed balance sheet and quantitative tightening, because that is actually going to have the most impact on.
All right, good people, we're going to come back to them. Sorry, it's hard to do all of this. I'm trying to trade live. I'm sharing with you guys what I'm doing. Remember, anything I do is not a suggestion for you to buy, hold, or sell. Yeah, cash up. Yes. So let's address that because we got time. Right. So a lot of you newer traders don't understand when I say cash up. I'm still probably 80% cash now. Why? Because I go in, I do short-term trades, and I add to my cash positions. Plus, I'm still DCAing, but I'm DCAing in small amounts. I need you guys to expand your thinking. Don't just have tunnel vision. You're going to lose money. A lot of you guys are losing money. I know I have colleagues out there that keep saying stuff like you missed the bottom and all of this stuff. And I wish they wouldn't say that. Even my dear friend, I wish they wouldn't. Because if you knew, you're just chasing the bottom. And while you're chasing the bottom, you're leaving a lot of money on the table. You guys saw me in 2 days between Friday and Tuesday. This Tuesday, you guys saw me make $14,000. You guys, listen, and even in Tesla, right? I've been in Tesla 15 times, good people. And I'm trying to show you guys that the reason why I am still, and I'm not telling you what to do. You're responsible for your own money. But as for me, I feel that something is coming. Maybe at the end of the year and maybe Q1. So me personally, I don't have all of my money in the market. I've been sharing with you guys these option plays. And if you don't know how to do options, please go and just take the time and stop trading and learn how to do this. But in these options, I'm in and I'm out, right? And I'm sharing with you guys. Look at this guy. All right, let's see what they're saying.
Describing, I was hopeful that the Fed was going to take a flyer on making policy on the forecast of inflation coming down. And instead, I very much agree with Rick that it's ignoring certain indicators that suggest inflation is about to fall. And I have to come to a bad conclusion here, which is that it gives me the sense the Fed is not going to stop until they break something. And I thought they had a
already
chance
broke something.
today. Well, I don't
Didn't
think it's
SVB
broke.
count for something?
Well, no, I don't think that.
How
I
many,
don't
three
think
of
that's
the
what
four
I'm.
biggest bank failures in history have happened since March, and they consider this not to be breaking anything.
Agreed. We can debate the degree of breakage out there, but I would just say that when I say break something, I mean the economy. I mean really to plunge it into recession. And it seems to me that there's a decent contingent, a hefty contingent of the committee right here that does not want to stop until they really break the back of economic growth here. And I think that's their outlook here, and that's why they're putting 50 more basis points on an economy that seems like it may not need it at this point.
Rick, go ahead and jump in. I saw you shaking your head vigorously.
You know, I completely agree with Steve's assessment there. They are driving forward, looking in the rearview mirror. Not only that, the brakes disconnected, the pedals to the metal on rate increases. I think this move and the hawkishness is purely for messaging. They paused. The pause is the issue we should not ignore. Why would they pause? Kelly's right. Considering everything, why would they pause? Because they want to be done. They just can't share that with the rest of us yet. That's my opinion.
All right, let's go. Greg, you'd like to jump in.
Yeah, Kelly, I think Kelly raised exactly the right question. Given all the data says they should go further, why pause? Let me just read from the statement. Holding the target range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. In other words, we want to see more information. We want to see if that 5 percentage points of cumulative tightening has the effects that we expect to see. I think that, being honest, they haven't seen those effects. I think if you want to be as generous as possible to the case, the thing they worry about most is that the trouble that they had with the banking system a few months ago is not over. We reported this week that they've got their eyes on 30 potentially problem banks. We all three of us have been through these crises before, right? You think it's over, it's not over. And I think there's a large feeling among every member of the committee that they really don't want to tighten into an incipient financial crisis, give themselves.
Somebody said fake numbers, and I actually agree with you. I really do agree with you. These are fake numbers. I don't believe that these numbers are real either. And I know you guys are, but Larry, did you just say, I really don't believe these numbers are real? Listen, where's my notes at? Look at this. All right. Here's why. This is the data that they read. Look at the Dow. I'm taking advantage of that. So I'm going to share with you guys live what I'm doing. All right. Hey, for all the core four. Hey, bless you. So listen, May CPI year over year increase. Car repairs, 13.5%, right? Car insurance, 17.1%. These are the things that rose. Electricity, 5.9. Rent, 8.7. Pet food, 13.8, right? So the average Americans are paying $261 more per month for goods and services. So we're paying more for goods and services in spite of, right? In spite of. So, but gasoline dropped 9.7%. This is what they're saying. Gasoline dropped 9.7%. Are you guys feeling that? Appliances dropped 0.2%. Are you guys feeling that? I just put 8 more trips on the book, all right? Because I'm traveling. They said airline fares dropped 13.4%. I don't see that. Do you guys see that? I see prices going up, right? Healthcare insurance dropped 20.5%. You believe what you want to believe. The person that made that comment, I agree with you. I believe that these numbers are not accurate. I'm not going to say they're fake. I don't believe they're accurate. Okay? So what am I going to do? Am I going to sit here and argue? No. If you want to be rich, do what rich people do. They're not getting into politics, all of this. They're trying to think smart, and they are trying to make money, right? And so that's what I'm doing, all right? And so let's take a look. Look at the bottom. I just bought that SoFi right in front of you guys. It's at 2%. And what am I going to do? I'm not even looking at a chart. I'm going to continue to add to that because I believe by June 30th, which I'm allowing myself 2 more weeks, I believe that SoFi will get to $10. That's why. And above it, I'm just holding it. Now, you guys saw me make $2,000 on SoFi, right? And then these are the Chinese ADRs that I'm in. I'm in Alibaba, as you can see that right there. I'm in JD. These are the Chinese ones that I am in, and I'm sharing this in real time. Now, I had one here. This was yesterday, TT.com, all right? I was down $33, 11%, and I just got out of it because it wasn't performing well as the others, all right? So I'm just sharing with you guys that while you're just holding on to every word that someone says in the past, you can make money. Clear this up and you can make money. Most of you that are out there that are at work in your stalls right now, I'm telling you that you could match what you're making at your job while you're at work. Just look at your phone in the morning. You guys know you're watching stuff. I'm just talking for a few minutes. We got time. You guys know you're watching funny cat videos and all of that. If you take some time and learn about the stock market, learn how to do options and learn all of this stuff. I know some people that are working a job and they are making more money in the market right now in a bear market bounce or a bull market or whatever you want to say it is. All right. But you got to think for yourself, right? I don't trust these numbers either. I don't believe these numbers are real. Thank you. They're pausing. Absolutely. Absolutely. So let's get this money. Let's get this money. You guys know I'm going to keep it real. Let's get this money. So when I say I'm mostly cash, I'm not telling you to be mostly cash. I'm just sharing with you that I'm mostly cash. Okay. And so I will just let you know I'm mostly cash. That's what I am. I'm just keeping it real with you guys. Right. And, you know, that it is what it is. Good people. It is what it is. Right. So let's see here. What else do we have here? And then someone, if these option plays explode tomorrow, somebody's going to come right on this page and go, why don't you share this with us before you make these plays? You guys see me doing it live right now. If I lose, I can't undo this video. This is losses. And swing trading is about losses and wins. But if your wins are far outweighing your losses, then you win. All right. So there is a way. There's always a bull market somewhere. There's a way to be in the market, make money. Leave me a comment if you agree, if you're doing it, and still remain mostly cash. Now, all of this cash, 14,000, 7,000 last week and $7,200 the week before. And some of you, 700 or 70, it doesn't matter. Percentage is percentage, good people. I'm just talking because they're not doing much. They're just talking until he gets on. But if you listen to what I'm saying, it's going to make you way more money. Get out of this head space, man. If you change this, it changes everything. I laugh sometimes at some of the comments because some of them are so, you could tell when new people get on and they don't have a clue. Well, I missed the bottom. You still crying about the bottom, and I'm making $14,000 a week, and you're still crying about the bottom. And somebody following me is making $1,400 a week. Somebody's following is making $100 a day while they're making $100 a day on their job, and you still looking for the bottom. Stop with the bottom stuff, man. Stop. You're looking back at a dime, and a dollar is ahead of you. All right. And I'm not pissed. I just want you to make money. I want you to prosper. Yep. All right. You noticed that, didn't you? You noticed that, didn't you? She went that away. I'm working it, good people. I'm working it at my age. Yep. I'm trying to do, just started. There you go. There you go. Just take the time to learn, good people. Yep. Let's see. Knowledge is power. Yes. That's true. Yeah, it's going down. Look at that. Look at that. Look at the indices. They all tanking, right? They're all going down, you know, and I'm just going to warn you. Thank you. Yes. God bless you too. God bless you. I'm just going to warn you, right? We've been doing these FOMC meetings for 3 years now, right? You guys know how this goes. The Fed is going to talk. He's going to say something. He's going to make the entire market go back down. And then he's going to say something else. The market is going to go back up. So that's why it's so dangerous to trade right now, right? I'm just taking the advantage when it go down. I'm not playing the ups because I know he could say something, it can go up, you can pile in, he'll say something else, it'll go back down. The farther it goes down, I'm telling you right now, the farther he tanks the market today, the more money I'm going to make. And I'm showing you guys and sharing you guys what I'm doing, right? And you guys know that the press is going to ask these questions just to tank the market. If you've been through this, leave me a comment. They're going to say, but what are you going to do for the rest of the year? Do you see a pause, or are you going to do some more rate hikes later? You heard them. The voting board, the FOMC board, one of them said they wanted to go up a full percent. All right. So all he's got to do is mention that and the market will tank. So when the market tanks, what I do, and I know it's a knee-jerk reaction, it's an overreaction, what I do is I'll go buy a little bit of something that I want because I know that that was a knee-jerk reaction. And before the day is done, I'm going to set the stop losses. We're going to set our stop losses. Let them knuckleheads argue. It's time for you and I to make money, okay? Off of these stupid politics, off of a billionaire and a millionaire running for president. They gonna be all right. They singing that song, we gonna be all right. And you and I are sitting here having these little dialogues, stupid, for every now and then you get a knucklehead that says, oh, but blah, blah, blah. No, man, let's all eat together. Let's get these plays and let's get this money. I make more money, good people. I make more money on earnings, FOMC meetings, and CPI reports. That's how I make the majority of my money. I don't even have to even trade any other time. Earnings, FOMC meetings, CPI, and more or less CPI and earnings. But when I see that the market is okay, look at the Dow. The Dow is nervous. What doesn't the market like? The market does not like uncertainty, okay? The market does not like uncertainty. They're getting ready. The market does not like uncertainty. We got 6 minutes, right? And so this happens every time. I've been watching this market since 92. Thank you. I know I don't look that old. And I'm telling you guys, this is, they call it dumb money. They call your money and my money dumb money because it's on commercial right now, so I'm gonna keep talking. Because we react emotionally. I don't. I got my plays right here. I got my eye on SoFi, Tesla, and Apple. And yeah, I can remember that. I got notes all over this desk. Because I'm ready. I'm ready to eat. I'm ready to eat. All right. I want you guys to be ready to eat. All right. Let's eat. Whether you agree with me or disagree with me, let's make money all together. And then we could argue later let's argue at the bank, right? Let's argue at the bank while we making deposits. Somebody else going to be making withdrawals. We're going to be making deposits, right? All right, so let's talk to people a few minutes. I'm sorry, y'all. I'm passionate about this. All right, bless you too. All right. Things are dipping. Yes, sir. There you go, Doug. Come on. Come on. There you go. Let's get this money. Yep. Let's get this money. SQQ. I didn't play the SQQ. I don't play the S's or the T's. I don't play the Q's anymore. When it was easier, like right now, we knew that he was going to pause, right? But a lot of people said he's going to pause, and a lot of people start playing the T's, right? The TQQ. Just think T for tall, S for short, right? Sorry, y'all. I'm sweating now down here. And so just think about that, right? And but the reason why I don't is the Fed could say one thing and the market could be going up. He could say one thing during an FOMC meeting and the market turns around and goes down. So that's why I don't. I am getting into longer term options. And as you can see, if you know options, if I plan on keeping it for a week, if I plan on keeping it for a day, I go out 1 week. If I plan on keeping the option for 2 days, I go out 2 weeks, 3 days, 3 weeks, 4 days, a month. That's how I do it. That way I can babysit it, run it up, and get out. Like CPI. You guys saw me with Tesla, Meta, all of that. You guys saw $7,000 a day. But I knew the morning of CPI, what? It was going to run up. So I just sold them all. And guess what? I get back in. All right. Yes, you can. Yes, you can. Yes, you can, but I don't use Moomoo for my options. I'm just be honest with you. I don't. Yes, you can. I check out my second link below. That is Webull. I do all of my options on Webull. Look at the market. Dow's down. Look at that. S&P is down, but it's still over 3,400, right? Yes, building knowledge for success. Patience is the key. Man, y'all killing it right now. Yep. Well, you guys saw me go in and out of Tesla so many times. I'm going to see. I haven't entered into a position on Tesla yet. I'm going to see if the Fed says something to cause the market to go down even more. And then I am going to do an option on Tesla. If it goes down more, I'm going to do an option on Tesla for 265, but I'm going to go out the 15th of July. So I'm telling you guys what I'm going to do. I'm absolutely telling you guys what I'm going to do. And then TSLA, when it runs up, I'm out. Yep, when it runs up, I am out. Let's see here. See, Tesla right now is 253. And I'm going to do one for 265. Matter of fact, I don't even have to do 265. I'm going to do 260 again, right? It's 253. I just do 260. I keep them tight because I'm going in and out. So I'm going to do, if the Fed says something and I look and see that the price of the options are dropping and he causes them to drop, I'm going to do a Tesla call option for 260. And I'm going to give myself a month. And I just keep it easy. I'm sorry, good people. I'm going to keep it easy, right? And so I'm just going to have it on. I'm telling you guys what I'm doing. Remember, anything I say is not a suggestion for you to buy, hold, or sell. And I may add to my SoFi options and my SoFi stock. Not just options, but I may add to my SoFi stock, right? So now my SoFi options are down. Now I'm down $95. And I like that because I'll probably go back in and double down even more. Let me take a picture so I can show it to you guys. I don't want anything to be exposed. All right, we got a few minutes. Let me do this right quick, and then I will be shutting up and letting the Fed talk. All right. Here we go. So you can see that so far. Now I'm down, right? I'm down, right? I plan on having about 20 call options. I plan on having 20, 25 options. Here we go.
Best 1 hour of television.
And here is Jay Powell. Thank you, Greg.
Thank you.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer-run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were three issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots, stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And, I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a sector. It's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive. And I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward, and we'll get to see. We don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision. Makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you can from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Thanks for taking our questions. Gina Smilik, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of, we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually in reality wind up being lower or higher. And there's really no way to know, but it's what people think as of today. And as the data come in, it can move around during the intermeeting period. It could wind up back in the same place, but it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously the current rate, according to the committee, is not sufficiently restrictive. Is it 5.6? Is it 6? Where's sufficiently restrictive? Thank you.
I would say again that I think that over time, the balance of risks, as we've moved from from interest rates at effectively zero now to 5 percentage points with an SEP calling for additional hikes, I think we've moved much closer to our destination, which is that sufficiently restrictive rate. And I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are getting closer to being in balance. I still think, and my colleagues agree, that the risks to inflation are to the upside still. So we don't think we're there with inflation yet because we're just looking at the data. And if you look at the full range of inflation data, particularly the core data, you just aren't seeing a lot of progress over the last year. Headline, of course, inflation has come down materially, but as you know, we look at core as a better indicator of where inflation overall is going. Sufficiently, so I think what we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, more with more data over time.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah. So it's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest-sensitive spending is affected very, very quickly. So housing and durable goods and things like that. But broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, and that makes it challenging, of course. So we're looking at the calendar, we're looking at what's happening in the economy, we're having to make these judgments. And again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that ultimate endpoint. I can't point to a specific data point. I think we'll see it when we see inflation, really, really flattening out reliably and then starting to soften. I think we'll know that it's working. And ideally, by taking a little more time, we won't go well past the level where we need to go.
I was curious if you could give us an update on what you're seeing on credit tightening since the bank incidents from March and how you're teasing that out apart from these lag effects.
So it's too early still to try to assess the full extent of what that might mean. And that's something we're going to be watching, of course. And if we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we would factor that into account in making rate decisions. So that's how we think about it.
Let's go to Chris.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip side of Nick's question, why signal additional rate hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or it's surprising to see so much hawkishness in the dots given what we're seeing recently.
Yeah, so we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level over 4.5%, far above our target, and not really moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We don't want to do. We want to do that with the minimum damage we can to the economy, of course. But we have to get inflation down to 2%, and we will. And we just don't see that yet. So, hence you see today's policy decision, both to write down further rate hikes by the end of this year, but also to moderate somewhat the pace with which we're moving.
Quick follow-up. I mean, the last press conference you mentioned you didn't see wages driving inflation, and there was some research from the San Francisco Fed suggesting wages aren't necessarily a key driver, but you've talked about the labor market today and the need for softening. Can you give us a little more specifically of how you see the tight labor market driving inflation at this point? Thank you.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. That was the origin, and it wasn't really particularly about the labor market or wages. But as you move through 21 into 22 and now in 23, I think many analysts believe that it will be important. An important part of getting inflation down, especially in the non-housing services sector, to getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks ago, which is very consistent with what I would think.
Go to Michael McKee.
Michael McKee from Bloomberg Radio and Television. You've said in the past that you don't like to surprise markets. It's kind of been the Fed's view a while to bring inflation down. You reiterated that again today, and that we would get to a point where inflation could be sticky. So I'm wondering, as we go into the next meetings, how Wall Street or others should look at your reaction function, what will you be reacting to, time or data? In other words, if nothing much changes, if we're looking at the same sort of labor market, the same sort of inflation levels in July or in September or November, will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live, and we'll just have to see. I think you'll see the data, you'll hear Fed people talking about it, and markets will have to make a judgment.
Well, do you think inflation is likely to continue coming down based on the lags and based on your threat of additional movement, or are we going to be in a period where we're not going to know what's happening?
I think if you look at if you just look at, I'll just point you to the forecast. So inflation is running, core PCE inflation is running at about 4.5%, a little higher than 4.5%, and the median FOMC participant thinks it'll go down to 3.9 on a 12-month basis. This is by the end of this year. So that's expecting pretty substantial progress. That's a pretty significant decline for half a year. So that's the forecast. We do try to be transparent in our reaction function. We're committed to getting inflation down, and that's the number one thing. So that's how I think about it.
Let's go to Victoria.
Victoria Guido with Politico. Could you talk about the balance sheet and how you're thinking about it? What are you looking for to judge whether we're approaching reserve scarcity, and is Treasury issuance going to affect that? Also, are you considering lowering the RRP rate in order to take some pressure off banks?
So let me say, first of all, on the Treasury part of it, if I can talk about that, and then go back to the balance sheet. So on that, of course, we've been very focused on that for a couple of months, as everyone has. Treasury has laid out its borrowing plans publicly. I think we all saw it. I saw the Secretary's comments yesterday to the effect that Treasury has consulted widely with market participants about how to avoid market disruption, and that they're going to watch carefully for that. So that's from the Treasury, which actually sets the borrowings. At the Fed, we'll be monitoring market conditions carefully as the Treasury refills the TGA. The adjustment process is very likely to involve both a reduction in the RRP facility and also in reserves. It's really hard to say at the beginning of this which will be greater. We are starting at a very high level of reserves and still elevated RRP to take up, for that matter. So we don't think reserves are likely to become scarce in the near term or even over the course of the year. So that's the Treasury part of the answer. We will, of course, continue to monitor conditions in money markets, and we're prepared to make adjustments to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are you considering lowering the RRP rate to help take some pressure off banks?
So we have a number of. I would say the RRP doesn't look like it's pulling money out of the banking system. It's actually been shrinking here lately. So I don't think that's not something we've thought about a lot over time. It doesn't really look like that's something we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
Janelle Marte with Bloomberg. Have you seen sufficient cooling in the housing market to bring inflation down? For example, how does the recent rebound affect your forecasts, and how does it factor into monetary policy?
So certainly housing, very interest sensitive, and it's the first place really, or one of the first places that's either helped by low rates or that is held back by higher rates. And we certainly saw that over the course of the last year. We now see housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. I do think we will see rents rents and house prices filtering into housing services inflation. And I don't see them coming up quickly. I do see them kind of wandering around at a relatively low level now, and that's appropriate.
Do you think you'll have to target that with further rate increases?
Well, I think we look at everything. We don't just look at housing. So I think, the way it works is individual participants sit in their offices all over the country and they write down their forecast, and including their most likely forecast, including their rate forecast, and then they send it in on Friday afternoon, and we accumulate it, and then we publish it for you. So that's how they do that. Well, I don't know that housing is itself going to be driving the rates picture, but it's part of it.
Let's go to Edward.
Thank you for taking the question, Mr. Chairman. Edward Lawrence with Fox Business. So I want to go back to comments you made about in the past about unsustainable fiscal path. The CBO projects the federal deficit to be $2.8 trillion in 10 years. The CBO also says that federal debt will be $52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Courtney.
Thanks for taking our questions, Chair Powell. So looking at the SEP, it looks like GDP for this year was raised significantly, your forecast for GDP this year. The unemployment rate, meanwhile, was pulled downward. And so should we take that as a sign that the committee is more confident about the prospects of a soft landing, at least as it relates to what you were expecting in March?
I would just say it this way. I continue to think, and this really hasn't changed, that there is a path to getting inflation back down to 2% without having to see the kind of sharp downturn and large losses of employment that we've seen in so many past instances. It's possible. In a way, a strong labor market that gradually cools could aid that along. It could aid that along. But I guess I want to come back to the main thing, which is, though, simply this. We see the committee, as you can see from the SEP, the committee is completely unified in the need to get inflation down to 2%, and we'll do whatever it takes to get it down to 2% over time. That is our plan. And, we understand that allowing inflation to get entrenched in the U.S. economy is the thing that we cannot allow to happen for the benefit of today's workers and families and businesses, but also for the future. Getting price stability back and restored will benefit generations of people as long as it's sustained, and it really is the bedrock of the economy, and you should understand that that is our top priority.
Just a quick follow-up on that. I'm just a little confused because you said the committee will do whatever it takes to get inflation down over time, but when I look at the SEP, inflation is still projected to be elevated next year, but the Fed funds rate is lower than where it is now. Can you help me understand that?
Sure. So, if you look 2 and 3 years out with the forecast, first of all, I wouldn't put too much weight on forecasts even 1 year out because they're so highly uncertain. But what they're showing is that as inflation comes down in the forecast, if you don't lower interest rates, then real rates are actually going up, right? So just to maintain a real rate, the nominal rate at that point 2 years out, let's say, should come down just to maintain real rates. And actually, since we're probably going to we're having real rates that are going to have to be meaningfully positive and significantly so, for us to get inflation down, that probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It has not so far reacted much to our existing rate hikes, and so we're going to have to keep at it.
Julie. The mic is coming. Oh, sorry. Thank you. Hi, Chaparral. Julie Chabanas, AFP News Agency. The May job report showed a rebound in May in black workers' unemployment. Is it consistent with the Fed's maximum employment mandate? Are you worried about that, about this rebound?
So we are, of course, worried about there are long-standing differences in racial and ethnic groups across our labor market. That's a factor that we can't really address with our tools, but we do consider that when we're thinking about what constitutes maximum employment. It is for us a broad and inclusive goal, and so we do watch that. But remember, all unemployment, including black unemployment, has been bouncing around right near historic modern lows here. So we're still talking about, what is as strong a labor market as we've seen in, a half century here in the United States. So overall unemployment of 3.7% is 0.3 higher than it was measured to be at the last a month ago, but still it's extraordinarily low. And so it's a very, very tight labor market.
Megan.
Thank you. I want to follow up first a little bit just on the rent question on housing. We heard Governor Waller talk about how, I'll back up, we haven't quite seen the slowdown in rents show up in CPI yet, and we did hear Governor Waller talk about how an uptick in housing might mean that there's not going to be as much relief coming, or a shorter bit of relief than we thought. Can you talk about how you're thinking about that and how that played into today's outcome?
I wouldn't say, so that's, as a factual matter, that's correct. We do need to see, rents bottom out here, or at least stay quite low in terms of their increases, because we want inflation to come down, and rental is a very large part of the CPI, about a third, and it's about half of that for the PCE. So it's important, and so it's something that we're watching very carefully. It's part of the overall picture. I wouldn't say it's the decisive part, but take a step back. What you see is look at core inflation over the past 6 months, year. You're just not seeing a lot of progress, not the kind of progress we want to see, and it's hard to avoid that. And the committee, people in the committee, the median went up significantly, so that the median participant now thinks that core PCE inflation on a 12-month basis will be 3.9% this year. So once again, every year for the past 3 years, it's gone up over the course of the year, and it's doing that again. So we see that, and we see that inflation forecasts are coming in low again, and we see that tells us that we need to do more. And so that's why you see the SEP with where it is.
Could you also talk briefly about your outlook for wages, and given the recent slowdown in core services, excluding housing, how far you think wages might need to fall in order to get inflation back in line?
So wages will continue to increase. So what we're talking about is having wage increases still at a very strong level, but at a level that's consistent with 2% inflation over time. And so I think we've seen some progress. All of the major measures of wages have moved down from extremely elevated, not extremely, but highly elevated levels a year or so ago, and they're moving back down, but quite gradually. And we would want to see that process continue gradually. Of course, it's great to see wage increases, particularly for people at the lower end of the income spectrum. But we want that as part of the process of getting inflation back down to 2%, which benefits everyone. I mean, inflation hurts those same people more than anyone else. People on a fixed income are hurt the worst and the fastest by high inflation.
Greg.
Thank you so much, Chair Powell. Greg Robb from MarketWatch.
I just wondered if the committee has talked at all about the labor market and there's strikes now in Hollywood, and now the United Auto Workers are talking about a possible strike. I mean, aren't workers, we have some workers have power now and are going to be seeking higher wages. Does that come up in your discussions? Thanks.
So the topic of wages in the labor market and dynamics in the labor market is about as central a topic to our discussions as anything. I mean, it's very labor economics, and the labor market are utterly central. It's half of our mandate, so we spend a lot of time talking about that. I think there are structural issues that are really not for the Fed. And so we don't spend a lot of time, although we take notice of what's going on. But we're not involved in discussions or debates over strikes and things like that. But we look and we see what's going on, and we're making judgments about what it will take to get inflation down to 2% in the aggregate. And as I said, don't think that was about. Most folks would say now it wasn't really about wages at the beginning. And it's becoming more about that as we get into really service sector inflation, which is the part of the economy where we have seen the least progress.
Let's go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. Wondering what your thoughts are now about systemic risk now that we're about 3 months past the failure of Silicon Valley Bank, and also specifically, what are the risks associated with commercial real estate as well as non-bank financials, and could you further elevate those risks with higher still rates, possibly for longer?
So we're trying to think where to start. I'll start with commercial real estate. Of course, we're watching that situation very carefully. There's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. It's well distributed. To the extent it's well distributed, then the system could take losses. We do expect that there'll be losses, but there'll be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that. We're monitoring it carefully. It feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way into systemic risk. In terms of non-bank financial sector, there's been a ton of work, and clearly in the pandemic, it really was the non-bank financial sector where issues really arose, and there's a lot of work going on with the administration, in particular, leading that to try to address issues in the Treasury market and in all kinds of areas in the non-bank financial market. But our jurisdiction at the Fed is over banks, actually bank holding companies and some banks. So that's really our main focus. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting. And so I guess that's what I would say.
Can I just follow up on the last part? That's, do you risk further exacerbating those issues if you get up to another 50 basis points?
So that's, and I guess I meant to address that by saying, as we watch, we'll see what's happening, and if we're seeing the kind of tightening of conditions that you could be referring to, then we can factor that, because really we use our rate tool it really has macroeconomic purposes, so we'll take that into account. Of course, we have responsibility for financial stability as well, and that also is a factor that we're always going to be considering. Thank you very much.
Well, that was Fed Chair Jay Powell. As you heard there, after what our own Steve Leisman today
described as a very hawkish pause. The Fed now projecting at least 2 more rate hikes before it's all said and done. Chair Powell saying nearly all policymakers see more hikes as necessary, also calling July a, quote, live meeting. The stock market's selling off almost immediately. It's been a little bit volatile, and it is somewhat skewed, at least as the Dow is concerned today, by what's been happening with United Health. But it was down by more than 400 points. S&P, as of a few moments ago, was in positive territory. So the market's still trying to parse out what the Fed chair said and what it thinks the Fed is going to do in the months ahead. Good afternoon. I'm Scott Wapner, of course. You're watching Closing Bell right here from Post 9 at the New York Stock Exchange. Double Line's Jeffrey Gunlock is joining me in
There you have it, good people. There you have it. Let me do the Ted couple. So there you have it, good people. They always banging papers. All right. So, man, I sweated that shirt out. I ain't gonna lie to y'all. So I'm trying to be. So we see that there was a pause, right? There was a pause, and then they're talking about a rate hike later, right? We also know that the voting board is all over the place now, right? Some say pause, some say hike, some say go up 25 basis points. You even had one that wanted to go up a full percent, a full point, right? So they're all over the place. And remember, this data that we're getting, the data that they just had CPI yesterday, Consumer Price Index. That just came in yesterday. And so now we are looking, remember, we're looking at data from last month, right? And year over year. So you got month over month, year over year. You got core CPI, which core CPI is just as, the way that they come up with core CPI is just as crazy as they could come. I'm going to tell you that 30% of it is in what is that? Used cars. Where's that at? It's crazy how they calculate this. And so we don't consume used cars every day. So that's some of the things we have to look at on these numbers. And knowing that, it helps you to do, Larry, thank you. Knowing that, then you know that these numbers are a bit skewed, right? A bit skewed. So I'm up 9% on my SoFi call, and I'm up 2% on my Tesla call, right? And I did that live. Now, this is not, I don't want you guys going in and going crazy, right? But these options are expensive. Okay, it's not coming up now. There it is. There it is. So as you could see, that's the Tesla. That's where we ended up on Tesla. And let me go back. And where did we do on the SoFi? And that's where we ended up on SoFi. But you guys will see that I gave myself what? Time. I gave myself a couple of weeks on SoFi, but on the Tesla call option at 260, I gave myself an entire month, right? Now, I could sell it right now and take a couple of $100s and go. That's how you use times like this. I always use bad news. I always look for the green and the red. And I know every single time one of these reporters are going to ask a stupid question that's going to cause the market to go down. I used to get tired of that. You guys saw me. I used to get tired of that just like you did. And then I thought to myself, you know what? Instead of getting tired of it, why don't we make money off of it? So now just make money off of it. But you got to be careful. All right. Yeah. So that's what we did. That's where we go. Hey, where did you buy that jacket? Hey, if you have a place called the Suit Company around you, there's one in Chicago, there's one in Maryville. Just tell them, stock up with Larry Jones. Go in there and say, what's up, good people? They will give you a discount. All right. All right. The Fed is buying opportunities. Yeah, man. It's that's it, man. Yep. That's it. Uncle Work. Yeah. It's called the Suit Company. If you, it's a chain. They have them in Chicago. They have them in Northwest Indiana. And if you go to the one in Northwest Indiana in the mall, it's called The Soup Company. Let them know that your boy sent you and they will give you a discount. As a matter of fact, I'm going to call them up there. And if you go up there and say Larry Jones sent you, I want to make sure they take care of you guys. All right. It's actually a suit. I don't wear the vest and pants. All right. So, but priced very reasonably too. You guys do know I do occasionally shop at Ross. Right. I'm not trying to flex. All right. Okay. Hey, yes, the Soup Company on 30. Yes. In the mall. Yep. Go up there. Tell them stock up with Larry Jones sent you. I'm going to call up there right now if you want it. All right. I don't get anything. They don't pay me, but I want to make sure that you guys get discounted. All right. Thank you. No more rate hikes due to debt ceiling negotiations. No, that's not factual. They said no more. They're going to pause now. There will be another rate hike in the future. The Fed always says data dependent, but we will see. All right, good people. It's been a long one. It's been an hour and 30 minutes. It's been an hour and 30 minutes. And I just really wanted to talk to you guys about, let's forget about trying to find the bottom. I'm showing you guys that I make money every single day. Okay. Now, I don't trade every day. I just wait. Good people. I wait for earnings. I make money on earnings. Buy the rumor, sell the news. I do that all of the time. I limit my risk. I make money on these plays. I just wanted to show you guys. It's difficult, but I just wanted to show you guys in real time. I cannot undo it. And what I wanted to say to you guys is that we have to stop just worrying, letting the Fed with these numbers, 30% of core CPI used cars. That doesn't make any sense. It don't make any sense, good people. So these numbers don't make any sense. So if they don't make any sense and you ask, why are they doing it? I used to ask, why are they doing it then? Because it don't make any sense. Why are they doing it? But this is what I understand. I do understand that somebody's making money off of these calls, good people. Somebody's making money off of these plays. Why not you and I? Why not you and I? Why can't we make money off of these plays? Why not? Why not? I'm going to show you guys right now what I did while we were live. I made over $600 in the last few minutes, and I'm going to show it to you. Let me take some pictures. Okay. Let me take a few pictures so I don't expose myself. Okay. And I really want to show you guys. That's right. Nothing makes sense. I just really want to show you guys that there's money to be made. And I'm passionate about this because I want you guys to make this money. I want you guys to make this money. All right. There's that one. Let me show you guys what I was doing live so nobody could say, oh, he did this, he did that. I did this live right in front of you guys. Right in front of you guys. Let's see here. Let me see if I can get this to show. So here is where I am now. It's the bottom one. The top SoFi I already had. That's just the stock. So I made 12% while the Fed was talking, right? Just while he was talking. Now, it's dangerous. I've said that. So I made 12% on 11 calls, right? I expect that to go up. That could go up to 100%, right? But then look at what happened at Tesla, right? Now, I went in heavy, but that's $500. And I believe that that's going to take off from there, right? And I just want to tell you guys, it doesn't matter if you have $200 or $20,000, you can make money. Only buy what you can afford. You can make money rather than going back and forth and you got high blood pressure and all of this. And this one said this and this one said that. Man, let's make money, family. I don't want anybody not to make money. Even the knuckleheads that get on here and say, oh, Larry's, he's blah, blah, blah. I want them to make money too. It's difficult to be. I'm a Christian, y'all. Y'all know it's difficult for me to be a Christian because I have to want them to do better too. And that ain't easy because some of these knuckleheads, right? All right. So, listen. You know what? Today I'm just going to talk about the class because Keenan Grace gives you an introduction into options, right? But Stocks with Josh shows you how to chart so you could properly do the options. I want you guys to look at both of those. Now, today, just now, I didn't use one chart. But if I was really using a chart and if I wasn't trying to keep the family fed, I could just sit here and make money. But that takes time. What I'm begging you to do is if you don't know options, is take about 3 months to get a basic understanding. Now, you may say, oh, I don't have that time. Yes, you do. Stop watching the cat videos. Stop watching all of this stuff and make money while you're at work, please. And what I do is I cash out. I hold these for days. I hold mine for days and I cash out. And then I add it to my cash position. That's how I stay 75 to 80% cash because I keep going in and grabbing cash off of the games that they play with us, you and I. At the end of the day, I'm going to tell you guys, all of these knuckleheads in Washington, they all got money. They got the best of health care. They got security. They got everything is paid for. We're paying for it all. And we're sitting here fighting. You knuckleheads that's driving down there with these rallying for this one and rallying for that one. Stop that foolishness. Go home and make money. I don't care who you rallying for. Rally for yourself. I'm going to shoot it to you straight. All right? Okay. So that's what I want to leave, good people. Make sure you have your stop losses set. And just remember this. 20 to 25% is a good percentage to take profits. Not 100, 200, 300%. Now, some of these, as you know, I'll be up 100%, 200, 300%. That's fine. But what I do is I keep raising my stop loss. So those of you that's asking where you're going to sell it at, I'm going to keep raising the stop loss. It goes up, I raise my stop loss. And I don't get it tight. I don't have it a penny beneath, then it's going to trigger. I give it space because I'm in profit, and I never let the night go. I never let the session close without having my stop losses. Never. Because you can't do stop losses on options after the market is closed. So the higher it goes, the more I keep raising my stop losses, right? And if I wake up or in the middle of the day it triggers, or while you're at work, which most of you are watching me at work, if it triggers, I'm happy. It triggered in profit. And that's what I want you to, and don't go, oh, it triggered. Look for the next one. Every single day, there's a new opportunity. And I want you guys to stay focused. Don't drive the car looking in your rearview mirror, looking at the bottom. Oh, I missed the bottom. No. Look in the big windshield in the front, because that represents the opportunities that you have to build financial, for you to be financially set. Now, I will tell you this. For those of you that get excited about options or whatever, I'm telling you, your long-term investments should be at least 75%. So only don't blow up your accounts. A lot of people stop investing and they go all in on options, and then they wind up broke, and then they say the system is rigged. It takes temperament. Somebody said that. It takes patience. It takes time. I'm giving you guys all that I have. And I one of these days, I'm going to tap out and say, I don't want to do this no more. Right? But I want you guys to have everything you need. I don't care if you don't buy the class. I don't care if you don't do any of this. Get the free stuff. Look for the free stuff. But I want you, as I travel this world, as I travel this country, and I see all of you guys, what gives me energy is when you tell me you learned something and then you earned. That's what I like. When the Core 4 went to New York and people says, I kept losing money, I kept losing until you said this and it registered and I made more money. All right. So you guys know how this goes with the FOMC meeting. What you see the market doing right now is not the end of it, because the market has to take this information and digest it. And you guys know that normally takes a day. And so tomorrow, we will know the reality of this FOMC meeting. Let's look at it right now. As you can see now, the Dow actually has regained negative 222. The S&P and the NASDAQ are still up. That's what I like to see. The S&P still at 4369. And so that's good. That's good. Look at that. Look at those numbers. The Dow is actually recovering because what he said was mostly muted. Let's just call it what it is. People saying he sounds hawkish. This is what we expected. It was already priced in, right? You're welcome, Fred. You old school. You remember Fred old cabbage head? Was that Sanford and Son? I love that. All right. Putting away money in a 401k. That's it, Kathy. That's it, Kathy. Let's all bank up. Hey, Joe, this is a thanks. One of these days I will, man. One of these days I got some things coming up. Hey, come to Maryland. All right. Yeah, man. You know what? It's funny you said that. Josh just asked me to come to Maryland. He has relatives out there. So we may make that happen. Okay, Joe? Yep. My trading account. Okay, man. You young. That's cool. Yep. Hey, thank you. Thank you, Johnsons. Hey, I appreciate you guys. I would say buy long positions because big tech earnings are coming out. That's good. Big tech earnings coming out. You guys know how I play these earnings. I'm in and 90% out. So if bad news comes and it's been running up, bad news comes and it drops out, I'm good. My money is in my account. That's it. I'm just adding to my positions. So that's what I do. I want more of SoFi. The other day I made $22,000. I think it was $2,300 on SoFi. I made it off of a SoFi option. So you know what I'm going to do with that $2,300? I'm going to add it to my SoFi stock. And so if SoFi doesn't perform, I haven't lost anything because I won it off of the options off of SoFi. All right. You see, that's the way I do it. OK. Hey, Tampa. I love it. I love it. I love it. Hey, Florida. Yes. Kansas City. We'll see. We'll see. Mobile, Alabama. Yes. Denver, Colorado. All right. Hey, hey, I appreciate it, man. But be more. Yeah, I'll come to Baltimore. I love Baltimore. I was just saying that because, I truly in my hearts of hearts, I know everybody has different reasons why they are on here. I'll be honest with you guys. When I'm doing this all day long, I'm actually losing money by not trading, right? And, one day, it gets difficult because, I take time away from my family. I'm always on, it's like, that Jake from State Farm commercial. That's what I am, man. I'll be, sometimes my wife is asleep over here. I'm over here with the light shining on the bed. And she's like, who is that? I can't say Jake from State Farm. I'm looking at Bitcoin in the middle of the night, and you got to cut this off. And I'm on 24/7, my wife getting sexy with me. Hey, boy, you getting them muscles on. I'm like, girl, show me your portfolio. I'm just joking, y'all. But you know what I'm saying. You don't cut it off. It's on. I talk with Josh and those guys, man, and we're on 24/7 because we're getting all these questions, trying to give you guys the best. And you know what? I gave the report yesterday. I'm going to end with this. I gave the report yesterday. I want you guys to think about this. I don't care how long this is because this is some of the stuff I want you to know. All of these stocks that I bought just now, somebody sold them, right? And when I sell them, somebody else is going to buy them. The 5%, I'm talking about America, and wherever your country is, it's the same thing. The 5% that has 60% of the wealth. So the 5% that has it, they're getting it from us because our school system teaches us to be what? Good factory workers. Now, your factory may be a cubicle. And my wife said, I'll get sexy with you or something. I can't even show y'all what she's all right, girl, I'm coming upstairs. All right, so and so the 5% is making money off of us because they're the ones, he who has the goal makes the rules. They're the ones that came up with the rules. They're the ones that's teaching us in our schools not to be entrepreneurs. They're not teaching us financial literacy. They're teaching us algebra, triple trig, something you'll never use the rest of your life, but they won't simply teach you financial literacy, right? Why not? Because they need your money. That's why. They want you to be an emotional trader. They want you to lose money, or they don't want you to trade at all. They want you to buy the goods and services that makes them money. And what do you mean by that? Every time you buy a $5 cup of Starbucks, I say thank you because you're adding to my Starbucks cup of coffee. Get it? Every time you buy a new Apple iPhone computer or whatever, I say thank you because you're adding to my Apple stock. You get it? It's just as simple as that. Money is transferred. So that 5%, let me show you this. Aston Martin. Look at this. I said this yesterday. I'm going to say it again. The sales of Aston Martin's automobiles are up by 80% this year. The customization of those Aston Martins are up by 92%, which causes the Aston Martins a lot of times to be double the price. Keep that in mind, right? The average price of an Aston Martin is from $316,000 to $2.7 million. It gets better. They are increasing their prices quarter over quarter of the cars without resistance, and the sales continue to climb. Think about that, right? And so who you think is buying these Aston Martins? The 5%. Where are they getting the money? From the 95%, because they know that you're going to spend your time watching cat videos on TikTok. They know you're not studying. They know that you're going to be an emotional trader. You're going to get your emotions in and you're going to tap out. That's what they know. And they taking your money. You don't think they taking your money. They don't need a gun. They are taking your money. As a matter of fact, you just saw me make some trades. And I'm just telling you guys the truth. I'm going to keep telling you the truth until you get tired of hearing it and do something about it. And the best thing you could do for me is make some money. Make some money. Get it? A lot of you are making money. So my SoFi just went up 12%. Yep. And Tesla's dropping a little bit. I may buy more because I believe in it. Of course, I'm going to have my stop losses in, right? Sorry about that. So, guys, as we could see, they're talking about the bond yields. Listen, I am telling you for those of you that haven't, I want you to just play this video. It shows you all of the classes that are in here. My theory is talk to me like I'm 3. I talk to you. I make it so anybody can understand it. And somebody said, man, you talk so basic, because I want people that don't know anything about investing to understand it. But please take the time. Don't just blow through the lessons. Take the time. Please take your time and get an understanding. And all by get an understanding, because there's money to be made. All right. And for most of you that are at work, you can make money while you're at work. You could look at your trades in the pre-markets before you go to work. Make sure you have the two, make sure you have Moo and Weeble, right? And Fidelity. I got 3. And then you could see what's going on, look at a little news. You could listen to the news while you're on the car or on the train on the way to work. You could set your plays. And then from your potty break, you go into a stall. You can check your, I'm being real. Check you see what's going on. If you were into an option, you see it falling, but you see, and you read the news on it, because right under the chart, there's news articles on it, and you can see that is something good is happening, it's going up. You can set your positions. Don't go all in. Start with one contract. Take your time, be patient. You can make money. And I talked to someone the other day in New York. They said that what they're making off of options is more than what their job is paying them. And I simply told them, stay on your job as long as you can and continue to just pile up. All right. I'm going to leave it right there. Make sure you check out the links below. Hey, I don't care. I don't care how long this is. I want you guys to get it. All right. I love you guys. I will see you tomorrow. I'm tapping out today. Live, love, laugh, learn. You guys know what I say. Be kind, rewind, do it again.